This ain't a sleepy summer week. It is going to be a busy week. 30 minutes until we kick it off. I'm Dani Burger.
And I'm Sally Bakewell. Bloomberg Open Interest starts right now.
Coming up, Treasuries extend their rally as Wall Street games out Bessent's next move ahead of Jackson Hole.
The Bank of Nvidia takes center stage as rising costs loom over earnings later this week.
And Canada braces for a long U.S. trade war, while Washington warns an economic D-Day is coming. Sally, I want to look at some of the stocks they're watching. Let me take everyone over to the board over here, because Nvidia earnings, they are going to be the big catalyst for this week. We're going to get into the story with Ed Ludlow in just a moment. But it plans to raise prices on some production as memory chip costs weigh on margins. But it's been down for 6 consecutive days. So we get a rally this morning. Some of the other players in the tech ecosystem in memory, for example, falling. Micron down 3.6%. We're also watching metal, auto, and agriculture stocks as Canada is set to apply counter tariffs on $20 billion of U.S. products next month. So the U.S. producers, those shares rally. But Sally, the big market driver this morning, reports saying that Treasury may opt to draw down some of its cash pile to expand buybacks of higher-yielding older securities. President Trump spoke on his belief in Treasury Secretary Scott Bessent over the weekend.
No, not at all. No, he's a very capable man. He wanted to do it. He's very good at it. He has a good touch, very good natural touch for the bonds and interest, and he did that, yeah.
The yields have come back up since then. Have you talked to him about another type of intervention? Is that something he will be doing?
We have many types of intervention. That's one. The ultimate intervention is our military. And if we have to use that, we will.
Reporting for duty is Bloomberg's international economics and policy correspondent Michael McKee, joining us now from Jackson Hole. Let's put aside the idea that we're going to drop bombs on the bond market or what it may be for just a moment. I want to start with the CNBC report that we got this morning, Michael McKee. The way that we might be funding the Treasury buybacks, what did we learn and what sort of implication might that have?
Well, the Treasury has about $900 billion in its general account, and that's because they've tried to build it up in recent years in order to have enough money to get through at least a week of government obligations. This came about after the last government shutdown, when they were concerned they couldn't meet all their payments. And so they do have a big pile of money, and that does affect the size of the balance sheet and has an impact on the Fed. But if they want to spend it down, they can. It won't really have an impact on the economy as such, although it would put more cash into the coffers of the people who sell back the bonds to the Treasury, and that could have an impact on other asset classes if they put that money to work.
And so thinking about Jackson Hole coming up this week, with inflation running at stubbornly ahead of target, all this geopolitical uncertainty, the fresh milestone of 40 trillion of public debt, and now this new information from CNBC about how the bond buying will be funded. What do you think the market needs to hear from Fed Chair Kevin Warsh?
Well, what the market needs to hear, Sally, and what the market may hear could be two very different things. The symposium starts Thursday night, but Friday is the speech at 10 a.m. Eastern time. Everybody will be watching because they do televise this, and there's no Q&A, so he just gets to make his points. Wall Street looking for a speech that's going to be at a high level, not down in the weeds about what's happening on the economy right now. It will justify his reform efforts at the Fed. There's a division, though, on the reaction function. How much do we get in terms of specificity, in terms of an if-then function? If the economy does this or that, what would the Fed do? And also, we don't know whether he's going to comment on whether they're going to continue to have news conferences or whether they're going to have fewer meetings, as came up in the minutes that we saw last week. So kind of leaves the question of where Warsh is going to leave us with all this going on right now. Michael Hansen over at JP Morgan put together a chart that shows since 2000, the standard move in the 2-year yield has been 5.5 basis points after a Fed governor's speech. So we'll see whether he moves the market or not. There's no forward guidance for sure because he won't give us that, but will he reassure the markets on inflation? That's the question. The bottom line question I think you're asking. And I think where it leaves us is waiting for the PCE at the on Wednesday to tell us what the latest in their target inflation is, and then the all-important CPI on September 11th that will really set the stage for what the markets think the Fed is going to end up doing.
And then even before we get that, we're going to hear from Treasury Secretary Scott Bessent this early afternoon. Mike, we're going to catch up with you in the next hour because there's a lot to go through. Bloomberg's Michael McKee. And make sure you stay tuned throughout the week. Bloomberg will be having special coverage of Jackson Hole that kicks off on Thursday. So again, kind of a crazy week to get through. Not only the macro, but we also have big earnings this week. It's going to be Nvidia on Wednesday, and Bloomberg has learned that Nvidia's biggest customers have been notified of price hikes due to soaring costs for memory chips. Bloomberg tech host Ed Ludlow joins us now from San Francisco. It's the task of Nvidia this week, ensure investors that the AI boom race is going forward. Ed, what difference does it make that Nvidia not only is having to raise prices because of memory costs, but is confident in its ability to do so and continue to have demand?
The attribution here is really important. What Bloomberg's reporting is the server makers, who are the traditional sales channel for Nvidia anyway, the OEMs that take the GPU and integrate it into the server, are notifying some customers that there will be 15% price hikes on Blackwell and Rubin-based systems starting in the new year, 2027. It's not Nvidia going direct to the world and saying we're raising prices. That's not how the sale of accelerated computer systems work anyway. It goes through the server sellers, but it's not a surprise given the environment for memory chips. Each Blackwell GPU or Rubin GPU has 8 corresponding stacks of high bandwidth memory, and high bandwidth memory chip is just 12 layers of DRAM, and so it's completely logical. The question is, how does that impact the bigger picture? And going into this earnings print, revenue will double from the same period a year ago. Adjusted EPS will double from the same period a year ago. What happens way into the future is what the street always wants.
So, Ed, what does this mean for Nvidia's lasting dominance? Does this pricing situation, does it create a bigger opening for some of its competitors to come in?
So what's really interesting is it's being interpreted a little bit that it's evidence of Nvidia still having a monopoly on this market. A technical monopoly in Bloomberg speak is, beyond 70% market share for accelerated computing. Lots of the hyperscalers or data center operators are working on their own chips, in part so that they have diversity of supply, which is important, and also to lessen their dependence on Nvidia. But what's ironic is that lots of those custom chips are DRAM-based systems. That the amount of DRAM memory proportionate to the compute is really important, and so they're also competing with Nvidia for supply of that DRAM. So net, this is being read as Nvidia's in a strong position. It has 75% margins anyway, which in this industry, is historically not real. And they maintain it.
Yeah. The numbers are incredible every time, even though the market has tended to trade down after Nvidia earnings for, I think, the past 4 quarters. Ed, we're going to have to leave it there. Thank you so much for joining us. Looking forward to Bloomberg Tech. That is in about 2 hours' time. Let's turn now to trade. Bloomberg reports that Canada sees little chance of restarting trade talks with the president of the United States before the midterms, now vowing to match dollar for dollar the tariffs the U.S. is putting on the country. Let's get more with Bloomberg Washington correspondent Tyler Kendall. Tyler, it's clear something broke down. What did in the trade talks between the U.S. and Canada?
Well, Dani, at this point, both sides are blaming each other for this really sudden reversal when it comes to the trade talks, keeping in mind that last week we got relatively positive indications from both that they were getting closer to a finalized deal. I had asked President Trump this directly, and he told me that the deal was done. They just needed to cross the T's and dot the I's. Now, we heard from the USTR, Jamison Greer, confirm that the U.S. was set to lower levies on those sector-specific tariffs, including autos and metals, and perhaps eliminate completely the levies when it comes to lumber. However, we're learning from the Canadian side, they're saying that there was just too much disagreement on too many things, and that includes on some of the important nuances here, such as that the U.S. did not want to extend the tariff relief on autos to medium and heavy-duty vehicles, such as trucks. We're also hearing from the Canadian side that the U.S. wanted to impose and constrain Canada's ability to make trade agreements with other countries, though we didn't really get much detail beyond what that really was shaping up to look like. So it appears that there was just too much here for them to ultimately get a deal over the finish line. But now we're risking this tit-for-tat escalation. You mentioned that Canada is set to impose retaliatory measures starting on September 8th. And I'll point out also, Dani, that we got these signals that Canada really is appearing to prep for the long haul. The Canadian Prime Minister, Mark Carney, says he's going to roll out a domestic aid package to help businesses that are expected to be hurt by these tariffs.
And so we're waiting now for more details on this economic D-Day that the US has threatened to unleash on Iran and its trading partners as well. Now, given the chokehold that's been on Iran for the past 4 decades, what really are we expecting to learn that is particularly different or indeed going to be more damaging, considering the punishment the country's already experienced?
Well, Sally, that is the big question. As you are outlining here, at this point, Iran has weathered waves of sanctions, and their economy has taken a significant hit during this conflict, with inflation data showing us that the country is facing levels at nearly 80%. The big question here is whether the U.S. is going to target, in particular, Chinese refiners of Iranian crude and the banks that helped to fund them. That would perhaps be the biggest pressure point that the U.S. could apply. But as we've heard from the U.S. Treasury Secretary already preview, this is going to be about the U.S. going after Iran and its current trading partners. That, of course, extends beyond China. Also, we're going to be closely watching when it comes to countries like Turkey, India, and also the UAE, which already moved last week to apparently cut off financial ties as well. We're getting some indications that China could be prepping for some sort of U.S. action, considering that new this morning we heard from officials in Beijing who said that they were urging a diplomatic solution here. Sally, that comes on the heels of Iranian officials, the more moderate members of the government, like Iran's president and parliament speaker, also saying that they would like to see a diplomatic solution ahead of this U.S. action. But that doesn't mean that that's what's going to happen, considering that we got a statement from the IRGC saying that they are prepared to sustain whatever the U.S. brings their way.
Tyler, we appreciate it. That's Bloomberg's Tyler Kendall in Washington, D.C. 20 minutes to play for in your future session until we get cash trading underway. Here's how things are shaping up. The NASDAQ underperforming, down 0.5% as some of the memory and chip stocks start their day on a sour note. 10-year yields, though, those are coming in nearly 2 basis points. The acceleration, again, from this story from CNBC just about an hour and a half ago, that the Treasury could use general accounts in order to fund bond buybacks, so not necessarily the front-end issuance from T-bills. They would be tapping into that taxpayer-funded source of capital. Brent crude, that's also helping yields come down 1% as we give Treasury Secretary Scott Bessent the benefit of the doubt ahead of his speech later today. Let's look at some of the individual movers this morning. With that is Nora Melinda. Hey, Nora.
Hey, Dani. Some stories I'm tracking this morning. First up, Alibaba raising a record $10 billion in Hong Kong to fund its AI build-out. Investors, though, questioning whether the company really needs to spend even more on AI. Shares of Alibaba pointing lower by about 1.5% this morning. Next up, the hunt for a deal is still going strong. Temu owner PDD reporting strong earnings as consumers search for cheaper options. But the company is also facing more scrutiny around the world, including questions about the quality of goods sold on Temu. Shares, though, higher by about 3% in the pre-market trade. And finally, another twist in the Paramount Warner Brothers Discovery saga. California's Attorney General reportedly canceling a meeting to discuss a lawsuit settlement. California and 12 other states are trying to block the merger, arguing that it would hurt competition. Seems like this is just a story that keeps on giving, Dani. The shares of Paramount Skydance higher by about 0.1% this morning. Those are your morning movers. Dani?
Nora, thank you very much. Yep, the New York Times reporting that story this morning. Coming up, fast fashion retailer Shein enters the final stretch of an arduous journey to go public. We're going to take a look at its lofty IPO goal, but I should say not lofty at all compared to OpenAI, Anthropic, or SpaceX. Still, we'll have that next. This is Open Interest. Let's get you some high interest stories. A look at what's making headlines around the world. Morgan Stanley's Mike Wilson says that a renewed spike in oil prices is the biggest risk facing U.S. stocks. In a new note, he writes that another advance in oil prices could drive yields higher and eventually force the Fed to act as Chair Warsh seeks to bring inflation back to target. He recommends using energy shares to hedge your portfolio. The FT reporting that Shell has drawn interest for Exxon and LyondellBasell for its U.S. chemicals business. The portfolio includes facilities in Louisiana, Texas, and Pennsylvania. The UK oil major is looking to offload underperforming parts of its operations, which could fetch up to $8 billion. In other deal news, Shein is seeking to raise as much as $1.8 billion in its Hong Kong IPO. A filing to the stock exchange shows that the offering would give the fast fashion retailer a valuation of $27 billion. It's due to debut on the Hong Kong Stock Exchange September 1st. Let's talk more about IPOs globally. And here in the U.S., joining us is Bloomberg senior reporter Bailey Lipschultz. I guess we got to talk about this one, Bailey, even though, like 27 billion. What is that? It's not $1 trillion. It's not $2 trillion. Who cares? But this is a long-awaited IPO we're likely to get in Hong Kong.
Yeah, Danny, it's a long-awaited IPO. And remember, this is a company that raised privately at closer to $100 billion just a few years ago. So how the mighty have fallen. And interestingly enough, again, this is a company that was debating potentially going public here, then going public in London, and ultimately, as you mentioned, going public in Hong Kong next week. So there's a lot of debate, about how they source some of their materials, as well as kind of everything around tariffs and what have you. But when you look at their results, they reported a net loss relative to a net gain. It's going to be interesting to see how they price and how this thing trades in Hong Kong.
Okay, so turning to another IPO on a potentially much more sizable scale. The market, of course, absorbed the SpaceX IPO, but we now know that Anthropic could target a potentially even bigger IPO. Can the market absorb that when it comes to equity issuance?
I think when we talk to bankers and investors, there's no doubt that the market can absorb it. The big question is, what are the knock-on effects? When you think back to SpaceX, there was a little bit of hand-wringing over kind of a slight pullback in the market, but all things considered, that priced remarkably well. You think back a few weeks, Intel raised $20 billion in a follow-on share sale. So the expectation that Anthropic, as we had reported, would raise more than SpaceX did, so pre-green shoe north of $75 billion, is kind of well received and kind of well telegraphed, if you will. Where we sit here in August, the big question then becomes, what follows on behind Anthropic? Does the market broadly hold up given all the geopolitical concerns? And then ultimately, when do we see an OpenAI IPO, likely sometime next year? And what does the market look like for that company?
Bailey, can you just give us an update on the IPO of Anthropic, where it stands, timing, what that might roughly look like, where we stand on the actual numbers for valuation, some of the debt that they're bringing in ahead of the IPO? What is the latest?
So we've reported that the company could file publicly as soon as the end of this month. If you look at your calendar, month ends next week. So we've got a few days this week and into next week when they could file that paperwork publicly. The thing they need to get done before that, as we had reported, is they're lining up a revolving credit facility where they're going to tap banks for north of $10 billion. We had reported that could even get closer to $15 billion. So in terms of the cadence, you need to finalize that revolver, bring the other banks under the tent and kind of have their roles more formalized. You also have to schedule an analyst day so that these banks can have their analysts workshop their models before you make that filing public. That then would kickstart about a 15-day period before you could price the deal. So if you kind of do the back of the envelope math, if they can pull this together that quickly, file, say Friday or Monday, that would kickstart the potential IPO sometime in the second half later in September. We had been kind of targeting a potential offering in October. So these are all variables that could move this, the targeted IPO, the actual scheduled IPO, by a week here or there. But for all intents and purposes, we expect Anthropic to be public by the first or second week of October at the latest, and as early as the second half of September.
Bailey, just want to emphasize such good reporting that you've been doing. It's been really great to follow along and looking forward to reading more. That's Bloomberg's Bailey Lipschultz on the Anthropic IPO. Up next, JoAnne Feeney from Advisors Capital will be joining Sally and myself ahead of the opening bell with her top picks from AI and healthcare to industrials. That's up next. This is Bloomberg.
The markets are highly fragmented and stratified. We're starting to see a lot of investor nervousness. And by the way, we're coming up into that time of the year, September and October, which historically is a market volatility period of time. And as a result, investors are more nervous than probably they would otherwise be.
Guggenheim's Ann Walsh on surveillance. Let's bring in JoAnne Feeney, portfolio manager at Advisors Capital Management. JoAnne, I want to stay on the theme of nervousness because there's been chop in this market despite very strong earnings growth. Do you think that nervousness is just down to high valuations, which makes people take a step back, or are there fundamental reasons to be nervous right now?
Well, Dani, there's certainly always risks out there. And I think the main source of concern for investors right now, particularly in the AI space, is, for how long this earnings growth is going to last. We have, predictions coming from, the broader set of analysts out there in our own models that suggest that, earnings growth looks pretty strong for the next year. In fact, when you put valuations in that context, these stocks just aren't that expensive. You look at Nvidia, trading at like 21 times, and it's growing at more than double that. These are pretty attractive ratios, and that doesn't hold for all of them, by the way. But there are some opportunities out there, we think, particularly with this recent sell-off.
And with the explosive growth in AI, I mean, what is a good way to play that trade, both from the equity and from the debt perspective?
So we're doing it in both ways. So I manage some of our balance strategies. So we obviously have a fixed income component there, and I have a team. We have a team of folks that focus on that. But they are also doing the deep dive into company fundamentals. And we see opportunity both among the hyperscalers, for example, in their debt, but also clearly still on the equity side, both with some of the hyperscalers and also the chip guys. So if you're looking just at the AI opportunity, we think there's real value attraction right now. If you don't own stocks like Broadcom, Google, Nvidia, AMD, we think is a special opportunity because it has a chance to continue to gain share versus Intel and make a big move in the AI space against Nvidia. So there are opportunities here that are pretty attractive.
JoAnne, we're going to leave it there. You're going to stay with us, though. We have the market open to get through first. On the other side of this break, it's your opening bell. Just seconds away until we start your trading. This is Open Interest. I'm Dani Burger. Matt Miller is still off. We are looking at an S&P future session starting the week lower, only slightly down 0.1%. NASDAQ that underperforms. Memory and chip stocks not having a very good day. It's a week full of risk events, from Nvidia earnings to PCE to Jackson Hole and a Scott Bessent address to the nation in this early afternoon. So you have to get through all those, and maybe it will be only until then that we get definitive direction. We've got a cool one down at the New York Stock Exchange. If you haven't heard me yap about it on this show endlessly, I'm obsessed with tennis, so I'm very, very pumped about the U.S. Open kicking off Sunday. This coming Sunday will be the start of the bulk of it, but it's fan week this week, so you can see some of the qualifications coming in. So very cool having the USTA leadership down at the New York Stock Exchange. Over at the NASDAQ, we have SafePro Group. Their stock, they're a software company. They do defense software. They analyze drone imagery. As you can imagine, even though you're defense, if you're software, you've gotten rocked in this market. They're only up, I think, about 7.4% or something like that over the past 2 years, and they're celebrating their second-year anniversary of being a public company. Nvidia starting the trading day down about 0.2%. Micron and Intel doing even worse. So we're going to get earnings from Nvidia as the big catalyst of this week. They're planning to raise prices on some of its AI servers by more than 15%, as soaring memory chip costs drive up the price of its system. We're also this morning watching metal, auto, and agricultural stocks, as Canada is set to apply counter tariffs on $20 billion of U.S. products next month. Let's bring back in JoAnne Feeney, portfolio manager at Advisors Capital Management. JoAnne, you were just talking about how you want to play the AI ecosystem, but looking at this earnings growth of 30%, the bulk of it has come from energy and from the tech universe. Things like healthcare are looking nearly negative year on year. Consumer discretionary has had very weak growth thus far. How are you thinking about the universe beyond AI at this point?
Yeah, those big sector moves, Dani, that you just described really hide a lot of what's going on in the details. And so, as you know, right? We don't invest in indexes in the whole market. We're picking and choosing. We own about 50 stocks in a portfolio. So in consumer discretionary, for example, right, we don't want to own the whole group. You have to really be careful given the shape of the consumer in this country, right? We definitely still have a big proportion of consumers that are struggling against past years of inflation, and their budgets are tight and higher gasoline prices aren't helping. So you want to be careful where you have exposure. The upper end is doing quite well. And so we like to own a company, for example, like Williams-Sonoma, which we've owned for a long time. It's that affordable luxury. It draws in the upper middle class and higher, and they tend to continue to spend as they have been. Defensively, we like companies like Target and TJ Maxx. That's where folks that are being a little bit stressed can go down to, and we're seeing their traffic remain robust. And so there are places to go even in those sectors. But we have a lot of risks, geopolitical among them. So we want to own some defense companies like a L3 Harris, for example, in our growth strategy, or a Lockheed Martin or a Raytheon. These are ways to build in some protection into the portfolios in case things do flare up even more so than they already have done over there in Iran.
So, JoAnne, following the Treasury's intervention last week to try and tame yields at the long end of the curve, do you think that yields have peaked? And what do you expect money to start rotating into if they have?
Yeah, it's sort of hard to tell whether yields have peaked, and I think we can't know that because we don't know what's going to happen with the Iran situation. We're seeing yields across the globe go up. This is not just a U.S. phenomenon. And one of the reasons for that, we believe, is because countries are increasing their defense budgets in the wake of sort of the U.S. pulling back from its global position. And so that's putting pressure on yields across the globe. And here in the U.S., of course, we've had pretty high deficit spending for a while, getting higher because of higher interest costs. But ultimately, if Iran continues to be a problem and we can't get the oil out, we can't get the fertilizer out, that's going to transfer down into food prices as well as just transportation costs. And so that could easily put more upward pressure on inflation. And that will translate, we believe, into higher long-term interest rates as well as short-term interest rates. So it's very hard to know where rates are going. That's why we're real careful about our duration on the fixed income side.
And this, to Mike Wilson at Morgan Stanley, JoAnne, is the biggest risk, that you get higher oil prices in a way that forces the Fed to act, to hike rates. This is an equity market, though, that has been able to tread water around all-time highs despite the volatility and the high levels that we've seen from yields, considering this is an equity market that's been dominated by long-duration equities, aka tech, which has been getting even longer duration considering the infrastructure spending they've been doing. At what point does the bond market start to become more of a weight on the equity market?
Dani, it's clearly just math. Higher interest rates reduce the value of future earnings, and that is, probably already having an impact on some of these high growth names. We've seen them not perform as well as some others in the market. But the other thing I think that is affecting these names, number one, I think that the earnings growth they have can overwhelm that interest rate effect on their valuations, right? And we saw that before. But the other thing I think folks are concerned about is the shift in free cash flow for a lot of these companies as they borrow more, as they spend more on CapEx. Their free cash flows in some cases have turned negative. But I would like to just suggest that investors look a little bit beyond that. This is a spending cycle of choice. These companies can at any point in time decide, okay, we're going to pause, and then their cash flow is going to turn massively positive very quickly. And so folks really have to look at the earnings power and the free cash flow power.
Wait, JoAnne, can I just jump in on that? Do you think that a company might announce that we might get a hyperscaler saying we're going to press the pause on this to make sure our cash flow returns positive?
No, but my point is that they could. I don't think they're going to. And take, for example, the news this morning that Nvidia is reportedly going to increase the prices on some of their leading edge chips by 15% starting next year. That tells you that their demand is still out there. That tells you that the CapEx spending we've seen is likely to go up again next year, although at a lower percentage growth rate than we've seen this year. But it doesn't look like that it is coming to an end anytime soon. But the point is they're choosing to make those investments because they see the value in them, because they see the demand for AI applications growing quite substantially. And so they want to put their money there.
And so when it comes to Nvidia's earnings this week, where are you going to be looking for signs that the return on investment and all this CapEx spending is actually starting to bear fruit in the broader AI space?
Well, Nvidia is one of the ones that has tremendous free cash flow, and it's going up. And so they are clearly benefiting from all of this spending. Higher prices are going to help them do that even more so next year is how it looks right now. So for them, what we're looking for the earnings report is, look, they've set up expectations pretty high. The investor community is looking for a solid beat on their last quarter and a raise of their guidance. But what we really need to see are the details. What's going on with their new product rollouts, and then also these new, initiatives they've taken to invest in other companies to be a part of the build out for delivering AI services. Will they be creating a situation of recurring revenue off the services of AI compute? And that could be something that could really lead to a multiple expansion for Nvidia. And I think that we're hearing more and more about that possibility, which would be a real boost, I think, to Nvidia's opportunity going forward.
JoAnne, I've been thinking a lot about the AI ecosystem and just how much wealth is being created from the new companies that are constantly popping up, that are getting VC dollars, to these mega IPOs that are coming to market, that are making their initial investors quite wealthy. And from that, strange things are happening. San Francisco housing prices have been skyrocketing. Supercar auctions have seen their prices double in the past year, too. I wonder, just when you look at the entirety of the ecosystem, this wealth creation effect, if it is having some areas, I know those are incredibly niche, but if you look around and you just see maybe mini bubbles or things that concern you just from the amount of money that's coming from this sector, when so much is still unknown at what this technology will look like in the future.
Yeah, Dani, I think you're right to point out the narrowness of the beneficiaries in some of these cases, particularly with these IPOs. And clearly, San Francisco housing market is a great example of how that's going to have a very localized impact. Beyond that, I think we're seeing it a bit more broadly to folks that own the stocks of these companies. They're also benefiting. And the way that works, right, in the broader economy is these folks end up saving a lot of that, and it goes into investments elsewhere in the stock market. They end up spending some of it on, necessities and luxury goods, as we're seeing in those cars. So it does end up filtering down into the broader economy. But clearly, we're seeing a rise in income inequality, and that does inform which kind of stocks you want to invest in.
Hey, JoAnne, we're going to have to leave it there, but it's been so great to kick off the week with you. Thank you so much for joining us. JoAnne Feeney from Advisors Capital. Let's get a check on your equity market. We are about 10 minutes into your trading day, down by a third. We declined last week for the first down week in about 3, the first down week of the month. It's going to be a busy one this week. We'll see whether we can reverse things and get some gains. Amazon, Apple, Visa, MasterCard, so the payments firms doing pretty well today, along with all the financials. A good day for financials. Just a weird quirk of the general accounts, using that to fund the Treasury buybacks. It would have the net effect of putting more of that money into supply and into banks. Just something to think about. Micron doing poorly today, as is Nvidia. We're going to get their earnings on Wednesday. Sources telling Bloomberg that Nvidia is raising the prices of some of its chip stacks by as much as 15% as the price of memory goes higher. So a tough day for the chip sector. And because of that, tech overall is struggling. Because of that, infotech, the worst performing sector, down 1 1/3. Again, because of the big weights of these companies, it has the effect of dragging down the overall index with it. Consumer staples and financials are doing well. I was noticing a lot of the alcohol makers, so Brown-Forman, Morrison Coles, they're having a really good day. I don't exactly know why. Write to me if you do know why, but consumer staples up 1.1%. Coming up after this break, Nvidia plans price hikes. We're going to talk about that and their earnings. Details next. Talks between the U.S. and Canada had broken down over the weekend. Trump officially announcing a new hike to Canada on their tariffs coming January 1st. He writes on Truth Social that on January 1st, 2027, tariffs on all cars, trucks, both large and small, automotive parts and steel will be increased to 50%. Build in the U.S. and there are 0 tariffs. He goes on to say that Canada will be treated like a state no longer, and talks about the idea that they have been ripping us off. Again, talks between the U.S. and Canada last week originally seemed like they were making progress. They broke down, with Canada also saying that they would imply dollar for dollar the same tariffs on the United States. In this equity market, it is helping out some of the material makers here in the United States, specifically those that make steel. Steel Dynamics up 5.5%. Let's get you some top calls now. What the sell side is saying. Here with that is Nora. Hey, Nora.
Hey, Dani. First up, TD Cowen cutting its price target on Delta, but keeping its buy rating. Higher fuel costs are bringing down earnings estimates, though the firm says demand is still holding up. Shares of Delta Airlines up by about 0.8%. Next up, we were just talking about tariffs. Canada Goose getting a double downgrade. Wells Fargo cutting the stock all the way to underweight from overweight. It says that the firm says that warmer weather and tariffs are working against the parka maker. With risks building into the holiday season, shares of that company down by about less than 5% this morning. And finally, over to Chipotle. They're downgrading the stock to neutral from outperform. And the analysts summed this one up pretty well. Chipotle, quote, may need to spend more to grow less. Shares of Chipotle, though, up by about 1.4%. Those are your top calls. Dani?
Nora, thank you very much. We'll catch up with you in the next hour. Let's turn to the big tech news over the weekend. Nvidia's biggest customers have been told that AI server prices will rise more than 15% in many cases, driven by soaring memory chip costs. Let's discuss with Bloomberg tech editor Sarah Fryer. The reason behind it is clear, that we know memory prices have been going up, but what does it say about the pricing power of Nvidia, the fact that they're able to just pass this along?
Well, this week, as you know, is the week that Nvidia reports earnings. We'll hear a lot more about that demand, but it has been staggering, really, how much of a hold they have on this market. And it's interesting to see all of these other players like Google, try to build chips that can be alternatives to Nvidia, but they too are constrained by these memory chips and having enough access to the supply there. So, Nvidia, they will have to show, of course, increased demand. The expectations are for their demand to have gone up quite a bit. We've seen the spending commitments for the year, but a lot of it is going to depend on what they can get in terms of memory as well.
Now, Sarah, are these price hikes, are they just really a sign of unquenchable demand, or is there any kind of warning flag for a sort of capex squeeze that we should start to be worrying about?
Well, one thing we need to think about is how much of the capex increase that is planned or expected is not just due to enthusiasm for the potential of AI, but due to the crunch on supply, right? How much of the increase in spending is because we just have not enough to go around for everyone building their massive data centers worth billions of dollars, right? So I think we're going to be looking more at that and trying to figure out how much of this is indicative of confidence and of customer demand, and quite a bit is, and how much of it is because we need to get these supplies in the data centers now, and so we're having to pay more for it.
I'm struck by how much politics is also creeping into the discussion with this uniting issue around NIMBYism on data centers and not wanting it built. Sure, they can commit capital, but Sarah, is there a real bottleneck for them in being able to actually build data centers, considering discussions and actual moratoriums are increasingly happening in the United States?
The AI boom, it's making the fate of the tech companies so intertwined with local politics in a way we've never seen before. We've heard of cell phone bans in schools. We've heard of age restrictions on social media. This is about the physical infrastructure to build a place where you can grow these AI models. And for Americans who are looking at these in their backyard, it's the one symbol they have of how the AI boom is not enriching them the way that they would expect. Maybe enriching the stock market, it may be enriching the leaders of these companies, but for everyday Americans, they're seeing the data center as a sign of something that they're not getting anything out of. And so they're fighting it. And it's going to be a huge issue in the midterms if local communities cannot accept these in their backyards. What's going to happen to the plans to spend as much as these companies have planned to spend?
Yeah, I was looking at a poll, I think is from Heatmap Pro. 75% of Americans now oppose local data center construction. It's getting really remarkable. Sarah, thank you so much for joining. I have a feeling we're going to be talking later this week, too. after and before probably Nvidia earnings. Thank you so much. Again, Sarah Fryer from the Bloomberg Tech team. Coming up, a look inside the president's portfolio. We're going to break down his trades. That's coming up next. This is Open Interest. "20 minutes into your trading day, we're down about 1/3% on the S&P 500. NASDAQ having a worse go of it, down 1 1/3% rather. We are awaiting Nvidia earnings on Wednesday, so that could shake things up. The Russell 2000, that is down despite the fact 10-year yields now down 4 basis points. They've been dropping. They're already dropping this morning, and then we get that report from CNBC that perhaps buybacks will be funded from the Treasury by general accounts rather than T-bill selling. Brent crude, that is down 1.4%, also helping yields come in. Nvidia, I mentioned, is down. This is its 7th consecutive day on track to decline. Over the past 6 days, it's fallen by about 5%. Micron, a bad day for them too, down 7 and about 0.1%. Ford and GM, those are also falling this morning after the president putting on Truth Social that he will indeed be imposing 50% tariffs on Canada come January 1st of 2027. Maybe that gives them a little bit of time to work things out. We also learned about some of the president's trades, Meta and Palantir. Among the stocks that this president traded in June, we have new disclosures. They showed that Trump made over 1,000 trades in that month alone. Joining us now is Bloomberg senior editor Bill Ferries in Washington. Bill, first of all, great to see you. It's been far too long, my friend. This is just an absolute flurry of trades that the president made. What do we know about them?
Right. So we had another White House disclosure on Saturday that detailed 1,000 trades, or about 1,000 trades in June. For comparison, he disclosed about 2,700 trades in the first quarter of this year and more than 21,000 trades last year before he became president. Again, he's trading, as you mentioned, a lot of the household names. We're talking about Palantir, Meta, Berkshire Hathaway. The biggest single sale, or the biggest single transaction, and these are reported in very broad ranges, was somewhere between $5 million and $25 million in a Vanguard ETF. But the curious thing is that you see a lot of his different accounts buying one day and selling sometimes within either the same day or just a few days later. So there's a lot of questions, of course, about the timing, but also the strategy behind this trading action.
Now, of course, the White House says that there are no conflicts of interest and that the accounts are independently managed, and his son, Eric Trump, has said they are in a blind trust. But is there a kind of symbolic weight to this that the market might take cues from when it sees what these accounts have been buying?
Well, there's certainly been instances where you hear the president or you see the president talking about a company, praising a CEO like, for instance, Jensen Huang of Nvidia, and then seeing some trading action when we finally get these disclosures a few months later. So certainly the market is noticing who the president is talking about, who he's criticizing, who he's praising. And we have seen, particularly last year with Liberation Day and all the flurry of action over tariffs, that there was a lot of trading going on before and after key days in trade and tariff negotiations.
I mean, Bill, all you need to look at and do and see in some of these names, and not necessarily saying there's conflict of interest, but the appearance of conflict of interest could be a problem in its own right. Palantir, I mean, they work with the government. Coinbase, Trump has been talking about crypto. We're heading into the midterms, Bill. Are these sorts of issues of conflict of interest, are they coming front and center now?
Well, we know that one thing voters have talked about is this perception of corruption, in the sense that perhaps politicians, there's been a lot of focus on members of Congress making stock trades, but it looks like the president is probably trading at a rate far higher than almost all members of Congress taken together. So that has become an issue. It's just the president is not on the ballot. We'll have to see whether voters punish the Republican Party or whether they see it as something against all incumbents in general come November 3rd.
Bill, really appreciate it. Great to see you. That's Bloomberg's Bill Ferries. Coming up in hour 2 of Open Interest, Claudia, Sahm, plus the CEO of Protolabs Digital on manufacturing, and we discuss alternatives with Athy Kriskey. 30 minutes into your trading day, welcome to Bloomberg Open Interest. I'm Dani Burger, along with Sally Bakewell, as equities sell off heading into a busy week. Coming up, we talk about this week. Treasuries extend their rally on Wall Street as it games out Bessent's move ahead of Jackson Hole. Nvidia will also take the earnings spotlight as rising costs loom over those results on Wednesday. And President Trump escalates his trade fight with Canada, while Washington warns an economic D-Day is coming from Iran. And we're going to hear from Treasury Secretary Scott Bessent later this afternoon. So we're waiting that guidance. And as that happens, President Trump over the weekend giving him a vote of confidence.
No, not at all. No, he's a very capable man. He wanted to do it. He's very good at it. He has a good touch, very good natural touch for the bonds and interest. And he did that, yeah.
The yields have come back up since then. Have you talked to him about another type of intervention? Is that something he will be doing?
We have many types of intervention. That's one. The ultimate intervention is our military. And if we have to use that, we will.
Some questions as to what that actually means, but Bloomberg's international economics and policy correspondent Michael McKee joins us now from Jackson Hole. Mike, the news of this morning, heading into a speech from Scott Bessent and one from Kevin Warsh, is reporting from CNBC suggesting that this Treasury could use funding and might use funding from general accounts instead of T-bill sales in order to fund the buyback. What does that give them in terms of increased lateral or firepower if that is the route that they choose?
It doesn't change the total amount of firepower, but it does change the way that they would act in the markets, which might have some benefit to them. The Treasury has about $935 billion in its account at the Fed. They've put that much money in there because they want to have at least 5 days worth of revenue ready to spend if the government needed it. They could spend that down and rebuild it at some point. But why the TGA as opposed to the other options? Well, it is a ready source of cash. They have it on hand right now. But most importantly for them, it would obviate the need to sell bills to offset the loss of the borrowing from the 30 years if they're buying those back. And so that would change the calculations in the markets, and it would also maybe keep interest rates a little bit lower for bills and a little bit lower for the 30s. So that would be the ultimate goal of doing something like that. But again, it's just a temporary fix. The problem for the markets is both inflation and the government's budget deficit, and they don't seem to be making any progress on either one of those at this point. And so eventually you get back to rates going up again.
So the genie is very much out the bottle with the Treasury Secretary's efforts to intervene in the bond market. So what do you expect the Fed chair to say about this intervention on Friday in Jackson Hole?
Well, you're right, Sally, and I think one of the casualties of all this is the Treasury's promise to be regular and predictable in its sales of bonds. This has all come up with the Fed in terms of what Kevin Warsh has said in the past about maybe a new Treasury Fed accord, about how they would manage the sale of bonds and the purchase of bonds by either side. Warsh speaking, of course, on Friday, no forward guidance. The markets are looking for him mainly to reassure them on inflation, and we do get 2 inflation reports coming up fairly soon. But the question is, would he say anything about this plan to essentially be an Operation Twist and bring the maturities down towards the bill end, towards the short end by the Treasury, which is also a goal of the Fed. So maybe they could work together, but it's probably too early to hear anything from Kevin Warsh on that.
Hey, Mike, really appreciate it. Looking forward to your coverage continuing at Jackson Hole. That is Michael McKee. And tune in to our Bloomberg Surveillance Jackson Hole special on Friday. We'll be drum beating to Fed Chair Kevin Warsh's keynote address. Coverage will begin at 9 a.m. New York time. Joining us now is Claudia Sahm, New Century Advisors, chief economist and former Fed economist. Claudia, great to see you. We'll talk about a Fed Treasury accord in just a moment, because I know you have thoughts there, but let's start with the morning's news of this potential to use the TGA in order to fund buybacks. What impact will that have if that is the source of funding in your mind versus something like T-bill sales?
So I fully agree with Michael McKee's summary of it. And this is a temporary measure. It will have, and when we're seeing the response in with interest rates this morning, I think that makes a lot of sense given the announcements. But we should remember the general fund is not there for this type of, working on the markets. I mean, this really has earmarked to programs that the government is spending money on. And so there are real limits to how much this intervention can do in markets, but it can do a little bit temporarily.
Now, you've criticized the Fed chair and the Fed for not showing their work, not explaining why their stance on interest rates. So if the Fed continues to refuse to show its work, does this introduce the prospect of potential policy error?
So first, I want to be clear. The person that's not sharing their work is the chair. Kevin Warsh has chosen to have, more of a 30,000-foot view of monetary policy. It can make a lot of sense for someone who's coming in talking about regime change. He wants to get us focused on the big ideas. But if you look at the committee, and say from the minutes that we got last week, they are giving details. They're explaining why they're still on hold. They're explaining what they're looking for in terms of inflation. So the details are still there at the Fed. It's just the sequencing has been a little unusual. But again, that could just be part of the beginning of having a new chair that's focused on regime change. But I do think we're at a point where we need to hear more of those details directly from the Fed chair. I think that will really calm a lot of nerves if we hear him articulate where the committee is.
I'm sorry to go back to this, Claudia, but just one more thing on the TGA, this idea of drawing this down even though there's no emergency. Is this something that looks more like shadow QE? Because in net effect, you are increasing the money supply. You're putting more out there and unbottles cash that would have been locked away in the TGA. Does that have an impact of stimulating the economy by unleashing this account?
So I'd be careful about drawing too tight a connection to quantitative easing. The Treasury can't create reserves. They can't create money. It's a little bit of like shuffling the deck chairs around in terms of what they're doing. It can have some effect that looks a little bit like QE, but really it's the Federal Reserve that could go out and create money and really accomplish this, bringing the long end down, bringing the short end down. But that's not a tool that the Treasury has access to. So they're very limited in what they can do. So I'd be a little cautious in calling this even QE light. It's really not.
Claudia, I wanted to ask you about the consumer because we've had a pretty mixed picture. Particularly last week, we saw Walmart stumbling on sales, Target raised guidance, Home Depot beat expectations, and then we've had some sort of interesting softening data. What do you think the actual reality for the US consumer is right now?
I think the reality is largely okay. I mean, some of the most recent data, there were timing shifts of when Prime Day was. I mean, it's really hard with monthly data to get a good picture. But if we think broadly about some of what consumers are facing, inflation that did move higher this year. I mean, that is a drain. And I think the idea that in the second half of this year, we're going to see more strain on consumers and their spending, that makes a lot of sense given what they're facing. So that we start getting data that lines up with that, I think that's what we should be expecting until that inflation comes down, those pressures come off.
Claudia, on a Fed-Treasury accord, as I mentioned, you've been doing some work on this or some writing on this, and you've said, look, there's a benign interpretation when you have such a large balance sheet and large debts. It requires maybe some level of communication, but you warned of maybe a less benign Fed-Treasury accord. What would that look like?
Right, and this is the real downside of Kevin Warsh staying at 30,000 feet when he talks. Is it's a little bit of a Rorschach test. We can read into it whatever we see. The critics see something really nefarious, and the supporters see something good. The benign version of a new Treasury Fed Accord is they talk more, they communicate. I mean, they already do that, but you could emphasize that when the balance sheet is this big and the federal debt's this big, we should talk more. Okay, fine, that's the benign version. The less benign version, and this has a history in the United States, is where the Fed starts taking orders from the Treasury. Get the interest rates down so we can lower the federal borrowing costs. I mean, there's a lot of incentive for that to happen right now, and that in history has led to inflation that really moves higher. And so that's the danger. So we have to be really careful about who is making the decisions about interest rates. Are they staying at the Fed, or is the Treasury really the one calling the shots? Like, we do not want to go down that path.
And so with 3 regional Fed presidents dissenting at the meeting in July, what impact will that kind of divisiveness have on the conversation that Warsh is trying to have with the market?
It's clear, again, reading the minutes, the conversation of the committee, while the majority still is of the opinion inflation is going to come down this year. And this is really their test for staying on hold as inflation keeps coming down and we see some improvements, some disinflation, but there's a lot of uncertainty. And they agree that the risks are to the upside. And I mean, frankly, the news reports we've gotten over the weekend, this really emphasizes there are some real upside risks to inflation. So I think the three dissenters are maybe a little ahead of the conversation in terms of they've seen enough, they're ready to raise rates, but there's a committee behind them that is really getting concerned that inflation is not coming down. And if they're not confident of disinflation, well, then the next very logical step is to raise rates.
Well, in the July presser, we had heard this from Chair Warsh that he hadn't decided whether it's going to be a big picture speech or whether it's going to be a more traditional setup for all of the action that we're going to have between September and December. Again, that was his words at the press conference. Claudia, what do you think? Is this going to be big picture or is this going to be something that sets us up for the rest of the year?
Yeah, I mean, this is the big question for the week. And in the end, he's the one that's going to decide. And I'll say that if you look back at the first speeches, Jackson Hole speeches of our last three Fed chairs, they're very different, right? And they express really the personality, the identity of that person. And in some way, with the benefit of hindsight, we see where they were headed in terms of some of the challenges that we had. So I think this will be very much a Kevin Warsh speech. I'm hoping we hear a few more details, but his track record is to stay pretty big picture. But it's going to be really interesting to see where he goes, like what topics he wants to engage, because there are some really live issues right now in terms of what's happening in Treasury markets. He wants to read financial markets. Tell us how you do that right now. I mean, this is a tough time to read markets. So I think we're going to learn something about Kevin Warsh, and that's really the main goal for Friday.
Claudia, we're lucky to have you to help set us up for this busy week. Claudia Sahm of New Century Advisors, thank you so much for your time. Let's get a check on your equity market now. 40 minutes into your trading day, same story, NASDAQ underperforming, down 1.4% as the memory chip makers and Nvidia fall ahead of that all-important earnings report. We are looking at 10-year yields coming down. Two things happening. For one, oil prices, as you can see, they're also moving down by 1.5% ahead of a speech from the Treasury Secretary in which the White House has talked about economic D-Day versus Iran. He gets the benefit of the down oil markets this morning. So we're seeing yields down by 3.5%, and also due to reporting from CNBC that we might get the buybacks funded for the Treasury via the TGA, the Treasury General Accounts. Let's look at some of the other movers on our radar this morning. With that is Nora. Hey, Nora.
Hey, lots of stories we're tracking this morning. First up, Nvidia planning to raise prices on some servers containing its AI chips by more than 15% in some cases. This comes as markets brace for Nvidia earnings due after the closing bell this Wednesday. Shares of Nvidia down by about 2.6%. Now, sticking with tech, Alibaba raising a record $10 billion in Hong Kong as it tries to get ahead in the global AI race. Investors, though, questioning whether the company really needs to spend even more money on artificial intelligence. Shares of Alibaba down by about 1.5%. And finally, we've been talking about it all morning, over to tariffs. Canada set to hit $20 billion of U.S. goods with counter tariffs next month. And then President Trump upping the ante, saying tariffs on Canadian cars, auto parts, and steel will rise to 50% starting January 1st. That's helping U.S. stocks today across agriculture, autos, and metals. You're seeing green across your screen this morning. Those are your morning movers. Dani?
Hey, Nora, thank you very much for that. I would point out we still are looking at Ford, though, down about 2.4%. Some of the automakers struggling this morning with those increased tariffs. Coming up, President Trump's family is on the verge of having its own bank. We're going to talk about that next. This is Open Interest. Let's get you some high-interest stories. So look at what's making headlines around the world. The second World Humanoid Robot Games kicked off this weekend in Beijing. China's Xinhua news agency reporting that a robot ran 100 meters in 9.39 seconds at the opening ceremony. That beats Usain Bolt's. Oh, that's the good video there. Sorry, I was hoping we had that. Anyway, sorry, it beats Usain Bolt's record. The games run through Wednesday include 51 events, including athletics, football, weightlifting, tug-of-war. Did you see these, Sally?
I did not.
This is pretty good, right? This is if you are worried about our AI overlords taking over the world, it's good therapy to watch one just run into a wall. So there you go, some viewing for the weekend. Speaking of which, picture-perfect AI resumes have pushed employers to bring back traditional techniques to sift through candidates. A number of London-based recruiters say that the use of AI in editing resumes has left companies flooded with similar applications, leading them to rely on methods such as live test, networking, and recommendations. Elsewhere, President Trump's family is on the verge of having its own bank. The president's relatives and business associates have won prelim approval to start one. Government data shows it is now easier than almost any time in 20 years to get a national bank charter, thanks to Trump administration's deregulation push. Let's get more with Bloomberg consumer finance reporter Paige Smith. Before we talk about the president family's business itself, what is happening at the office of the comptroller of the currency right now that you are getting all these bank charters issued?
I would say, first of all, thanks for having me. I would say that it is really a moment in time where the pace has been expedited for these technology firms and digital asset firms, fintechs, that are really pursuing a bank charter for varying reasons to either have some sort of decision given to them, but the vast majority are receiving approval from the OCC, the Office of the Comptroller of the Currency in Washington, D.C. And those are regulators that, I should point out, are appointed by President Donald Trump.
Now, is this a genuine, much-needed modernization of banking infrastructure that's happening here, or are there other drivers?
To be sure, there are a lot of fintech firms that have waited a long time, I would say, to apply to be a bank. And, you know, banking executives like Jamie Dimon have said for years that they want more firms to be, essentially, if you're offering banking services, you should be regulated like a bank. There should be a level playing field of sorts. But I would say that there are a lot of different firms that have sort of seen this moment and attempted to seize it. So we see, you know, firms like Circle and Coinbase and a number of different digital asset firms have seized on this moment to apply, and some of which have received approval to become banks.
Including World Liberty Financial, which is owned by the Trump family. Where do they stand in this process?
Including World Liberty Financial, which is owned by the Trump family. So World Liberty Financial has received conditional approval from the OCC to become a trust bank, to obtain a charter. And essentially they have said that they would like to use this bank charter to disseminate their stablecoin, and which is USD1, and really boost their business in that area. But we will have to see, right, of what the long-term trajectory of this entity will be. And yes, to be clear, the OCC is a regulatory body, the leaders of which are selected by President Donald Trump.
Now, stablecoins, they're not insured like bank deposits. So by letting a crypto firm become a bank, does that create an illusion of safety for consumers who might believe that their assets are actually federally guaranteed when they might not be?
I think that's a really good question. And I think that that is certainly a debate that's occurring among a lot of different people. I think if you were to speak with sort of more traditional bank stalwarts, they may say that, you know, this is concerning, whereas I think folks on sort of the more nascent technology side of things, or at fintech firms or digital asset firms, would say that this is a much needed change. And to be clear, under the Biden administration, there were very few bank charters approved, new banks formed. So it's certainly a departure from the prior administration, and the question of what the introduction of stable coins can do to our financial system is something that will be tested over the next few years.
It's something that a lot of the entrenched financial giants have been working on, from the card payment providers to banks to otherwise. What does it do to the competitive landscape to have these new entrants be able to come in and get a bank charter?
Well, if you think about firms like Nubank, which has received conditional approval to become a bank in the U.S., Nubank is a powerhouse in Brazil and also is growing in other countries around the world. So if you have sort of a consumer finance entity like that coming to the U.S., like, certainly it would be, I don't think I'm going out on a limb here to say that regional banking executives at least, and probably the biggest banks in the U.S. are watching closely to see what challengers like this might do. Revolut is another name, for example, that has applied to be a bank in the U.S.
Paige, thank you so much for joining us. A really excellent story. I recommend everyone go out and read it. That's Bloomberg's Paige Smith. Still ahead, we're going to be speaking with the CEO of Protolabs, a digital manufacturing company that works with Lockheed Martin, NASA, and Airbus. That's coming up. This is Open Interest. You're watching Open Interest. To check on your equity markets about an hour into your trading day. It's a tough day so far, being led down by the NASDAQ. Even though yields are coming in, that's not supporting this market. Brent crude, that's also helping yields come down 1.7%. Meanwhile, I just want to round up some of the AI news we had over the weekend. For one, there was an interview from Sam Altman where he said he was surprised that AI is not being as disrupted or adopted as quickly as he expected. The FT also reporting that Fable's usage, that's Anthropic's model, the highest tier, isn't being used as much as they expected. So you're seeing some of the AI ecosystem having a tough go of it. Alibaba, that's down because they're doing a $10 billion placement. And meanwhile, Ford and GM now having to contend with the president saying that they will increase Canada tariffs 50% on industries like steel and auto. So those stocks down at least 3% for Ford. Coming up, we're going to be speaking with the CEO of Protolabs on U.S. manufacturing. This is Bloomberg. U.S. manufacturing is getting a boost from growing demand across defense, aerospace, and drones. Protolab is tapping into that demand using digital manufacturing to produce custom parts in as little as a day. Its customers include major players like Lockheed Martin, NASA, and Airbus. I'm pleased to say joining us is the CEO of Protolabs. That's Suresh Krishna. Suresh, great to see you this morning. And just looking at your company, first of all, your stock is up more than 60 or nearly up 60% in the past 12 months. In the second quarter, you set a record earnings figure in which you raised your outlook. What's been going on? What has turned the corner for Protolabs this year?
Dani, thanks for having me on the show. We are absolutely a pioneer in software and digitally enabled manufacturing. And with the growth we are seeing in aerospace and defense, we are able to support all of the companies involved in that sector and drive the growth along with that sector's growth. In fact, aerospace and defense is about 25% of our revenues this past quarter, and we grew almost 20% for our aerospace and defense business year over year.
And on that raised full-year guidance, I'm curious to know how much of that was down to data centers and their expansion.
Yeah, we are industry agnostic, if I could use the word. We serve over 18,000 customers every year, and data centers, robotics, drones, space, all of these are important industries for us. We are serving companies like Amphenol and CommScope in data centers. We make very specialized products, which are fire-resistant cable trays, which are used extensively all over a data center. And that is growing almost 100% year over year for us, that particular sector.
I'd love to get your take then, Suresh, just how closely intertwined you are with the data centers and understand this industry. What some of the political backlash has done. We were talking about earlier in the show that there was a Heat Map Pro polling showed that 75% of Americans are now opposed to local data centers. As a supplier to this industry, how much is the local political pushback of data centers rolling the speed of your customers' expansion, for example?
Yeah, we are further down in the supply chain, right? So we would be supplying to companies like Amphenol and CommScope, who serve Meta and Google and Amazon. So we are a little further removed from that. So right now, what we are seeing is there is still significant activity that is flowing through our factories, and we see that for the foreseeable several quarters to continue. As far as the political backlash, we're not close enough to it to know how this might impact the future, but a lot of the announced projects are still going through.
So I looked through your filings, I looked on the terminal. Correct me if I'm wrong, but I don't think you have any debt at a corporate level. So I was curious to know how you have if you have any plans for debt or equity issuance, or are you just targeting organic growth, or are there potential inorganic growth opportunities for you out there?
Absolutely, that's a great question, Sally. We are looking at organic and inorganic growth. Our strategic plan, which we announced earlier this year, is to double over the next 5 years. And as part of that, while we are driving organic growth and we've done double-digit growth for 2 quarters in a row, we are looking at a pipeline of acquisitions. What our customers look for, and we serve 95% of Fortune 500 companies, they're looking for resilience in the supply chain. They're looking for speed as a strategic advantage. And the supply chain in the US has not traditionally moved at the pace that these customers want us to move. So expanding capacity is an important aspect of how we would leverage our balance sheet. We are sitting on about $160 million of cash, and we would use that for investing in capacity growth for our customers and also making acquisitions so that we can provide more services to our customers. We are known for being the best and the fastest prototype manufacturing company. As part of our strategy, we are expanding our services to being a production supplier while being very good at prototype parts as well. And to do that, we can grow organically. We also will want to use inorganic acquisitions to build that capability rapidly.
Your sort of aim and ability to move fast and the desire for that right now just underscores how much change the manufacturing industry as a whole has been undergoing, whether it be the demand for defensive goods and what AI and data centers are doing for things. You're also a board member of the National Association of Manufacturers. What are you hearing from other CEOs who are trying to navigate this landscape?
Yeah, Dani, NAM has a very critical role to represent the voice of manufacturers in this country, not just big manufacturers, but also the small ones. There's about 30,000 small manufacturers in the United States, which are the backbone of manufacturing for this country. NAM has advocated very successfully policies to help bring back manufacturing to the United States. And I'm really proud of the fact that I can partner with Jay Timmons, our president, and able to drive those policies to help the manufacturing industry. Most important being the rapid depreciation for capital goods investment. We need that kind of investment to happen in the US to help build what I would call a sovereign supply chain for US. When we look at defense industry in particular, and there is rapid disruption because we don't have the capacity in our supply chain today to build up everything that our defense industries need, we need the policies that NAM is advocating for to help our supply base rapidly scale up.
Hey, Suresh, really appreciate your insight this morning. Thank you for joining us, Protolabs CEO Suresh Krishna. Let's get a check on your markets this morning, and we are selling off. We are down about 1% for the NASDAQ, but it is off the lows of this morning. Your 10-year yield is down by 3.5 basis points, also aided by Brent crude. That is dropping now below $93 a barrel. That's down 1.8%. Let's look at some of the other movers this morning. With that is Nora Melinda. Hey, Nora.
Hey, Dani. First up, the hunt for a deal is still going strong. Temu owner PDD beating profit expectations even as revenue came in short. The company's also facing more scrutiny around the world, including over the quality and safety of goods sold on Temu. Shares, though, struggling to find direction for much of this morning, up about just above almost flat right now as we speak. Next up, and yes, another AI story, this time power. Mizuho initiating coverage of Vista and Talent Energy at Outperform, saying both could benefit from all the electricity needed to power AI data centers. That's not doing much for the stocks, though. You see both shares of both companies down in the red across the board. And finally, memory chip maker Micron is falling after Nvidia notified customers that it'll be raising prices for certain servers. All of this due to higher costs for memory chips. So Micron taking a bit of a beating, down more than 6% this morning. Those are your morning movers. Dani?
Nora, thank you very much. Let's talk more about the AI ecosystem. Joining us now is Bloomberg Intelligence Head of Global Tech Coverage, Mandeep Singh. And Mandeep, we're looking at a board of Nvidia, Micron, Intel, all of them down this morning. You would think that hiking prices because of higher memory costs would be good for Micron. Mandeep, I sort of posit to you that there's a lot of kind of negative stories out there over the weekend. The FT reporting that adoption of Fable from Anthropic is stalled because everyone just wants cheaper models. Sam Altman giving an interview saying he's surprised that AI adoption hasn't happened as rapidly he expects. I don't want to make too much from one day's movement, but it does feel like there's kind of some negative sentiment about just the adoption of frontier models at this moment.
I think we are past that token maxing stage. So there was a while when people were just, using AI and token maxing. So we are past that. Now it's more about figuring out where should we use the frontier models that are expensive. The tokens are very expensive, for Anthropic. So does the use case really require the kind of the premium models, or can you do away with open source models? And that's where I feel for a company like Anthropic, which is looking to go public in the next 2-3 weeks, it's important to have a good narrative. And that's where, a Sam Altman saying we were wrong on the timelines is probably good PR. They want to be on the right side of it. When these companies said they will eliminate 50% of the white collar work, that wasn't good PR. So I think now that as they're looking
hang on,
to...
but it's good PR like politically, but for them in their business, isn't it bad PR to be like, oops, people aren't adopting us enough?
Look at their ARR. For Anthropic, $65 billion in ARR when they started off the year at around $10 billion. Their growth rate is established. These companies are growing exponentially, tracking the S-curve. So nobody is really concerned about slowdown yet. We can talk about, Nvidia raising prices, but at the end of the day, everyone wants more compute. And that is a given. Yes, again, everyone has efficiencies that they're looking to bring in now that, AI infrastructure is becoming more expensive. But that doesn't mean they'll stop using. So from that perspective, I think we're pretty confident that AI infrastructure will get utilized.
So I think it's fair to say we're probably not expecting any big surprises from Nvidia's earnings on Wednesday. What do you expect the stock to do?
Well, so the stock hasn't done much over the past, 9 months. So from that perspective, expectations are low. The thing is, what could be positive surprises? And that's where it's hard to kind of see what Nvidia can say that will be a real positive surprise. They have had a history of beat and raises, but now that the numbers are getting so much bigger, there can be, a 20% beat and raise. So those days, I think, are done. It's more about maintaining their margins and making sure that, the NeoCloud system is intact, and then all the NeoClouds are still using Nvidia. And that could be, I think, good positive reinforcing data points.
Mandeep, could you just walk us through a world in which open source and less, bulky models not only become the norm as they are now, but are just like the lion's share in a world where that is what most people are using and Fable is used very rarely? Does that mean that the entirety of the ecosystem will suffer as a result? Does Nvidia have less demand? Do we not need all these data centers? Like, is that a big enough impact, or do you still need everything we're building out and all the money being spent, even if that is the way the world is headed?
In fact, Nvidia wants open weight models to be the bulk of the tokens because you still need the data centers and the chips to run the open weight models. It's just the monetization is different, and that's where Fable can monetize the premium use cases, but then you still have Jevons paradox where, the cheaper the tokens get, the more it's going to get used. So from that perspective, Nvidia is developing their open weight model, and they want to serve a rich ecosystem of open weight models.
Does it change the business model for Anthropic at all? If there aren't as many people using their most advanced systems, do they still spend all the money that they are in terms of developing them?
I think so, because they've been able to have that pricing power. And look, the reason why some of these models are not getting used are also because of the data residency rules. So in the case of Anthropic, they'd retain a lot of the data and traces that enterprises don't want them to retain. So that could be hurting their adoption as opposed to the pricing. At the end of the day, what we have seen so far is companies are willing to pay up for frontier intelligence. If your model is better, everyone wants to use your model.
Hey, Mandeep, so great to have you. Thank you so much for joining. One of the best, Mandeep Singh from Bloomberg Intelligence. Coming up, the U.S.-Canada trade fight escalates after talks collapse over the weekend. We're going to bring you the latest right here on Open Interest. President Trump officially announcing higher tariffs on Canadian goods. In a Truth Social post, Trump says that tariffs on Canada cars, auto parts, and steel will rise to 50% on January 1st. Let's get the latest from Bloomberg's Kayleigh Lyons, co-host of Balance of Power. Kayleigh, this is a decisively different place than we were last week. What happened in these talks that they've led to this post from the president?
Well, they all fell apart at the 11th hour, frankly, Dani. Mark Carney's government in Canada saying that the president's team, including the USTR Jameson Greer, simply made demands of Canada at the very end of these negotiations that Canada was unwilling to accept. Mark Carney, the Canadian Prime Minister, describing Canada as being attacked, suggesting this is now a war, hence what we are seeing now. Of course, when those talks fell apart, the U.S. already has implemented 50% Section 338 tariffs on billions of dollars worth of Canadian goods, including things like hockey sticks and alcohol. And Mark Carney has announced that Canada is going to retaliate. As of September 8th, the day after Labor Day, tariffs on $20 billion of imports from the United States, things like dairy, U.S. steel, other things as well. Electronics, for example, will face tariffs coming into Canada. So that is where the tit for tat has gotten to us to this point, where the president is now suggesting things will escalate even further. The timing is interesting, though, Dani. January 1st would indicate that there may be some room for negotiations between now and then to avert that from happening. But our colleague Josh Wingrove is reporting that Canada is not under any assumption that things will resolve in the near term. The Canadians, according to his reporting, do not believe that there will be substantial negotiations before the midterms and may be preparing to ride this out for the long haul, as in until President Trump is out of office in January 2029.
And of course, we're still awaiting details on what economic D-Day could mean for Iran and its trading partners. What are we anticipating in terms of how it will treat other countries, such as China, in any potential measures that are outlined?
Well, you're asking the million-dollar question, Sally, and we do expect we will hear more from Treasury Secretary Scott Bessent this afternoon when he is expected to give a briefing about what exactly these measures will look like. He penned an op-ed in the Financial Times over the weekend previewing what it could be, saying that countries who do not participate in isolating Iran will face consequences themselves. But, of course, it is unclear the extent to which the United States would be willing to oppose retaliatory measures against a country like China, especially just weeks ahead of President Xi Jinping's planned visit to the White House on September 24th. And China, of course, is the largest buyer of Russian oil, is one of those lifelines to the Iranian economy that the United States is trying to cut off through these measures, which essentially the Treasury Secretary says would include things that no one expected the Trump administration would actually summon. The authorities that they're looking to do here as they try to create an economic stranglehold on Iran rather than pursuing further kinetic action. They have already pointed to what they say has been success of the existing economic measures, keeping in mind Iran has been under sanction for nearly half a century. The U.S. naval blockade has been maintained for months now, and Bessent in this Financial Times op-ed pointed to 80% inflation in Iran, the weakness in the Iranian currency that we have seen as of late. He even likened what he and the administration are trying to do to compare to the effort in World War II and FDR and Winston Churchill. So it goes to show you how far the administration would like to reach here in hurting Iran economically, but it remains to be seen whether or not other countries will be buying into this.
Kayleigh, really excellent work as always. Bloomberg's Kayleigh Lyons looking forward to Balance of Power today, kicking off at 1 p.m. Eastern. Coming up, we're going to be speaking with Invesco's Athy Kriskey about what's driving demand for metals. That's up next. This is Open Interest. Time now for our metals spotlight, and investors are looking for opportunities beyond stocks and bonds as demand for metals grow. Invesco's Athy Kriskey says supply security and infrastructure investment are making metals increasingly relevant in a diversified portfolio, and she joins us now. Athy, thank you so much for coming in. Great to have you.
My pleasure.
Copper this morning, 3-month forward futures on the London Metals Exchange are trading at a record above $14,000. What is going on to copper at the moment?
And I love copper, but actually my theme today is the letter D. And I was Dani for your show.
Yep, I'm biased.
But I'm totally biased.
Continue.
Right. So, but what are the themes in copper, right? Deglobalization, data centers, and defense spending, right? So if we go to deglobalization, which is very unfortunate, right? We learn in business school that you should, globalization is great. If you're great at making something, you should make it and export it and then import what you're not great at making. But what's happening right now, and copper is strategically important, people are worried about the global supply supply chain, that they can't get enough copper. So we're seeing stockpiling or hoarding, right? And a lot of that is around this Sector 232 tariffs, right? So we're waiting to get clarity on that. Supposedly it's going to take effect in January, but there's been movement of this copper from the London Metals Exchange, the LME, to the CME, the Chicago Metals Exchange. So much so that 70% of exchange inventory is sitting in Chicago, right? Which is normally 30 or 40%. But again, these countries and these companies are doing this de-globalization, which is not good and causing prices to go higher. But then secondly, data centers. Now we all know the AI story, but copper literally sits at the core of that AI infrastructure build out. When you look at a data center, everything that's part of that process has to do with copper. It's copper intensive. So we try to train investors, like, rather than thinking of tech stocks, think about copper. And lastly, defense spending, right? We've seen this rearmament around the world as people are concerned, right? And so in weapon manufacturing and some of the defense spending, copper and a lot of the industrial metals are important. So we do happen to have a product, DBB, which is Delta Bravo Bravo, and it's the Invesco Base Metals Index. So it has both those CME and LME coppers, but also aluminum, zinc, nickel, and lead.
So if those tariffs are put in place, what kind of severe shortage do you expect those to trigger? Or will it just reroute supply elsewhere?
Well, we'll have to wait and see, but we think, yes, so that some things should calm down. We need clarity, right? So we don't know what's happening. But remember, part of the One Big Beautiful Bill was to build out, to reindustrialize the U.S. So we actually need copper here in the U.S. But this huge, big movement has been concerning, and it's causing these big, the market is really frustrated and confused and waiting to get clarity.
Shall we go to your other D, that's the debasement trade? How much is that changing the dynamic at this moment when gold prices are picking up, crypto is, as there seems to be this real concern about what the Treasury is doing and increasing sanctions on Iran, kind of weaponizing the U.S. financial system?
I love that. So debasement is really a trade around gold and really platinum and silver, right? But what does debasement mean, right? Actually, I laugh because it went back to Louis XIV when he actually took gold coins and traded them for copper coins, hence the debasement trade. But it is basically when governments are spending a lot of money and they're funding it with this government debt, and it devalues the currency, in our case, the dollar. So that $40 trillion number really scared a lot of investors, hence the big move for the debasement trade. But also, there's a lot of other things going on in gold that are supporting it too. So Secretary Bessent's move last week to the bond market was almost a catalyst under gold, right? As the long-term rates came down and people were like, we need to make sure we have gold. But also the central banks. Remember, last year, gold was doing it was the best performing asset, 53 new all-time highs. I love that stat. All right, but, this year, the gold, we lost some of the luster of gold just because people wanted cash and people were concerned about what Chair Warsh was going to do with rates. But now the central banks are back in. One of my other favorite stats, PBOC, right? In the month of July, they bought the most gold they have bought since October 2023, and the Central Bank of Korea hasn't bought gold in 13 years, and they were also back in.
Kathy, this has been so excellent. Not enough time. You're going to have to come back and join us.
Great, my pleasure.
So great to see you. That's Kathy Kriskey of Invesco. And that does it for Open Interest. We will be back tomorrow with Bob Dahl of Crossmark. Sally, thank you so much for joining. Been a pleasure to have you.
It's been great.
That does it for Open Interest. See you tomorrow.